At the end of the last lesson, we have mentioned that, in reality, perfect hedges may not always be possible. And in this lesson, we will focus on imperfect hedges. The causes of imperfect hedges could be the following. The unavailability of futures contract matching the asset obligation dates. The amount of asset obligated may not be an integer multiple of the contract size. Lack of liquidity in the futures market. The terms of delivery may not completely coincide with those of the obligation. The unavailability of futures contract with underlying asset exactly matching the asset to be hedged. In order to measure mishedge, we'll introduce the concept of basis risk. The so-called basis is the difference between the spot price of the asset to be hedged and the futures price of the contract used for hedge. Note that both prices are taken at the same time point. To examine the nature of basis risk, let's consider the variation of basis over the time period from T1 to T2. Let Fi, Si, and Bi denote the futures price, spot price, and the basis at time points Ti, for I equals to 1 and 2 respectively. Then, by definition, Bi is equal to Si minus Fi, for I equals to 1 and 2. This graph shows a typical time profile of spot and futures prices of certain assets. We can see that the two prices coincide at the maturity of the futures. And the difference between the spot price and futures price is denoted by this red line, which by definition is the basis. And we can see that the basis tends to 0 when time approaches to maturity. Let's again consider the short hedge first. Assume a hedger who knows that the asset will be sold at time T2 takes up a short futures position at time T1. Then the effective price obtained for the asset with hedging is S2 plus the difference of F1 and F2. Rearrange this expression, we have F1 plus the basis at time T2. Note that at time T1, the value of F1 is known, but that of B2 is unknown. Therefore, the hedging risk is the uncertainty associated with B2, called the cover basis. The uncertainty in the realized effective price constitutes the basis risk. If we express F1 as the difference of S1 and B1, then the effective price can be alternatively written as S1 plus the difference of the basis at time T2 and T1. Here, B1 is known as the initial basis. In general, basis risk increases as the time difference between the hedge expiration and the futures expiration increases. Therefore, it is always preferred to choose a futures contract with an expiration as close as possible to, but later than, the expiration of the hedge. Now let's take a look at a concrete example. It is March the 1st. A US company expects to receive 50 million Japanese yen at the end of July. It is known that yen futures contracts on Chicago Mercantile Exchange have delivery months of March, June, September, and December. Each contract is for delivery of 12.5 million yen. In order to hedge the risk of the depreciation of the Japanese yen, the company takes up a short position of 4 September Japanese yen futures contracts on March the 1st. After the Japanese yen cash flow is received at the end of July, the company closes out its position. Suppose that the futures price on March the 1st in cents per yen is 0.78, and that the spot and the futures prices when the contract is closed out are 0.72 and 0.725 respectively. Determine the total amount received in US dollars by the company. With the given information, we can calculate the gain on the futures, which is equal to the difference between the futures price at time T1 and T2. and also the basis when the contract is closed out at time t2, which is the difference between the spot price and futures price at time t2. Then, the effective price can be obtained by either of the following method. First, the spot price at time t2 plus the gain on the futures at time t2. Second, the futures price at time t1 plus the basis at time t2. Both methods gives the effective price at 0.775 cents per yen. Then, the 50 million yen received by the company is equivalent to $387,500 US. Second, let's consider the case of a hedger who knows it will buy the asset at time t2 and therefore takes a long futures position at time t1. The effective price paid for the asset with hedging can be calculated as follows. The spot price at time t2 minus the difference of the futures price at time t2 and t1. And rearrange this expression, we can get that it is equal to the futures price at t1 plus the basis at t2. Again, the hedging risk is the uncertainty associated with the basis risk B2. Here's a concrete example of long hedge. It is June the 8th, and a company knows that it will need to purchase 20,000 barrels of crude oil at some time in October or November. Oil futures contracts are currently traded for delivery every month on New York Mercantile Exchange, and the contract size is 1,000 barrels. The company therefore decides to use the December contract for hedging and takes a long position in 20 December contracts. The futures price on June 8th is $18 per barrel, and the company finds that it is ready to purchase the crude oil on November the 10th. Thus, it closes out its futures position on that day, where the spot price and futures price are $20 and $19.1 per barrel respectively. Determine the eventual purchase price of the company. Again, the effective purchase price per barrel can be calculated using two equivalent methods. First, the spot price at time t2 minus the company have gained from the long position of the futures, that is, F2 minus F1. Second, the futures price at time t1 plus the basis at time t2. And both methods gives the effective purchase price of $18.9 per barrel. Then, the eventual purchase price of 20,000 barrels is $378,000. So far, we have dealt the cases when the maturity of the futures used for hedge does not match the asset obligation date. In fact, a hedge that is established with a maturity mismatch, an asset mismatch, or both is referred to as cross-hedge. Now let's consider the case when the underlying asset of the futures is different from that the hedger has exposed to. Suppose the futures price for this proxy asset is denoted by Fi star at time ti, where I equals 1 and 2 respectively. Let S2 star be the price of the proxy asset at time t2, and S2 be the price of the asset being hedged at the same time point. Then, the effective price for the hedge is the spot price of the asset at time t2 plus the difference of the futures price of the proxy asset at time t1 and t2. After some simple algebraic manipulation, this expression can be written as F1 star plus the basis risk, where this basis risk consists of two terms: the basis of the proxy asset at time t2 plus an additional term that represents the basis arising from the difference between the two assets. Note that the above discussion is under the assumption that the size covered by the futures contracts on the proxy asset is equal to the size of the exposure. This might not be the best strategy. In the next lesson, we're going to introduce the minimum variance hedge, which is one of the simplest models that suggests an optimal size for the hedge that minimizes the risk.